world order. A fragmented global economy.
With the Strait of Hormuz closed, a global energy shock now threatens Asia and Europe, putting energy markets back on edge. A potential fuel crunch building while AI strains global grids.
The inflation effect of rising energy prices.
So a lot of disruptions in the whole global supply chain.
When uncertainty creates risk,
Asia is being hit by shock after shock. And this shock is particularly pertinent for Asia because it's so energy dependent, intensive, it relies on imports. I'm also worried that people are talking about a weather shock of a super El Nino. So you could have a combination of shocks which will not augur well for Asia.
resilience becomes survival.
What we're seeing right now is this, refocus from investors on that corporate resiliency story.
Dependence of oil may not be the best bet. And you've seen the data now that electrification could actually be cheaper.
It is manifestly in our interest to pursue decarbonisation, clean energy, whether it's from an environmental point of view, which is hugely important, or from an economic point of view, which is often easier to sell politically.
The question is, can you handle the next shock? Today, we explore what it takes to build a more resilient future. Welcome to the Bloomberg Sustainable Business Summit, Singapore. Please welcome to the stage Meg Szabo, Managing Editor at Bloomberg Live.
Good morning, everyone, and welcome to the Bloomberg Sustainable Business Summit. Great. Everybody taking their seats? Wonderful. This is our 5th year in Singapore. Back in 2022, sustainability was framed through the lens of ESG and climate. Today, the discussion has evolved, but the underlying question does remain the same. How do organizations create long-term value in a changing world? Geopolitical tensions, trade fragmentation, energy security, climate risk. These forces are reshaping the operating environment for every organization. Today's discussions will examine how leaders are responding to that reality. Before we get started, I would like to take a moment to acknowledge our summit advisor, Bangkok Bank, and participating sponsor, Burrito Renewables. We also encourage everyone to download the event app today by scanning the QR code that is behind me, or will be behind me. There you go. This will have a lot of important information. You can connect with other attendees. You can view session information as well as like the breakouts that we have today. And you can submit questions to our speakers. I know that our first session speakers are really eager to answer your questions, so I encourage you to download that now, get your phones ready, get your questions ready, and you'll use that a lot throughout the day. With that, let's get started. We have a brilliant team of Bloomberg journalists covering the forces that are reshaping Asia Pacific. They'll kick off today's program with the stories, risks, and opportunities they're watching closely. Please join me in welcoming to the stage Bloomberg's Ishika Mukherjee, Lily Pike, Steven Stupczynski, and David Stringer.
Good morning, everyone, and thanks for being here. Before we start, just to reiterate, my colleague Meg, she did mention downloading the app will help you address questions to us, and also we're going to make you work this morning. Start you off as we mean to go on with a couple of polls. If you do download the app, you'll be able to participate in those polls through this session. I want to start with, well, the session is what we're watching, and what we've been watching, like all of you here, I guess, very closely for the past 5 months, are the impacts that we've seen as a result of war in Iran. Stephen, you manage our energy team here in Asia. You and your colleagues have been reporting and documenting many of the impacts that we've seen on energy markets, on supply chains. Which of those responses have we seen that have been sort of most acute? What's short-term fix, and what are we seeing that's really going to deliver long-term change to the energy system in this part of the world?
Yeah, certainly. I mean, for us at Bloomberg News, the big event from late February onward has been the war in Iran and the closure or the near closure of the Strait of Hormuz. That has had a huge impact across the region. It's not only choked a fifth of seaborne oil supply, but also about 20% of liquefied natural gas supplies, most of it coming to Asia. And it's having a direct impact on how governments and companies think about the use of LNG and fossil fuels specifically in their energy mixes. So in some places, we've seen a knee-jerk reaction to double down on coal because it's available. In those places, we're seeing, for example, Japan had increased coal output and reduced LNG. But then in other places, we're seeing a acceleration in adopting renewables. Of course, this won't happen overnight. It will take time. But I think one of the countries that we looked at quite closely was the Philippines. It's been really fascinating seeing how the government has pushed forward policies to add more large-scale solar projects to the grid. But at the same time, you're seeing a response because the Philippines, the power prices are directly affected by oil, gas, and coal. They did see an uptick in electricity rates. I think only second to Singapore, their power prices are the highest. And you're seeing, because of that, a shift by households and businesses to also install solar panels. And the Philippines overtook Pakistan as the biggest importer of Chinese solar equipment for the first half of this year, which is really fascinating. You're seeing even in places like Vietnam and Thailand, where LNG imports were supposed to be part of a rapid growth engine well into the 2030s, some projects rethink whether or not to use LNG and to use renewables and batteries instead. And then other countries like Pakistan and Bangladesh, which are being hit the worst by this, they're dealing with energy shortages and higher prices, and that's going to cause a radical rethink as to whether or not they can continue using these fossil fuels in the future.
Let me pick up on one of those points, but just before I do, and at the moment we can see a chart there showing that real influx of those solar imports to the Philippines that you mentioned. As I said, we'll make you work, and I think it's time that we have our first poll. We'll bring the poll up. As I said, do use the app to submit an answer, and then we'll bring you the results just in a few moments. We'll give you some time to do that. What we want to hear from you, we'll hear from our panelists, but how has the Iran war affected the clean energy transition in Southeast Asia? Is it speeding up as a result? Has it slowed down, or are you seeing no net effect? Steve, just to return to your comments, you mentioned Pakistan, Bangladesh sort of rethinking LNG purchases. How exposed are some of Asia's, I guess, for want of a better word, sort of more cash-strapped economies, the ones that are more sensitive to price? How are they navigating it? How hard are they being hit?
Pakistan received 99% of their LNG from Qatar last year. So suddenly overnight, they weren't receiving any shipments. There were, the way that they're dealing with it is, unfortunately, they had to implement some pretty long rolling blackouts. Load shedding is what they call it in some of the biggest parts of the country. You've seen them increase the use of coal. You've seen them increase the use of nuclear, actually. They were able to increase output above capacity at their nuclear power plant. But also, they're having to scramble to use potentially more renewables. That's driven not so much by government policy, but just the fact that if they're increasing power prices, increasing regasified LNG prices, that is forcing businesses to really look for ways to reduce their dependence on that fuel. Bangladesh as well has had to cut gas supplies to their fertilizer producers in order to make sure that there was enough gas going to power plants. So I think, for both of these regions, or both of these countries rather, it isn't a matter of, kind of getting through this easily. This is quite literally an energy shortage. It's an energy crisis. And the way to deal with this, unfortunately, is to just cut energy use altogether.
Lily, if I can turn to you, we've talked a lot about Southeast Asia. You've been on the ground in China quite a lot in recent weeks. You've seen firsthand some of the nation's clean tech exporters. I guess the other side of the equation here has been the beneficiaries of some of the disruption we've seen. How are those companies, those clean tech exporters, how have they been benefiting from the disruption?
That's right. I cover China and climate change, so we've been watching this topic very closely. Will the Chinese companies be benefiting from the impact of the war? And the early signs we see are that the companies are receiving a tailwind from the war so far. And I think that's clearest with EV exports. I was actually in Beijing a couple months ago for the auto show that's held there every 2 years. And it was just wild to see all the Chinese companies trying to pivot to tackle the markets that are seeing oil shortages. And I talked to several automakers who said they were surging their sales teams to certain markets to try to find those new opportunities. So we saw really clear evidence of that. And it's borne out in the numbers too. We see the first half of the year that Chinese EV exports are up 120%. So I think that's the clearest sign we have across clean tech that Chinese companies are really benefiting so far. But it's also true in other technologies. So batteries in particular are seeing a big boom right now. And that's clear actually in Pakistan, where we saw this solar boom a couple years ago, but now batteries are following suit. So countries that are seeing these really high electricity prices, they want more stability. Short term, that might mean coal, but it also might mean investing in battery storage going forward so they can, weather these blackouts. Finally, for the solar piece, though, we're seeing sort of mixed signs. So in some countries like the Philippines, we've seen a real boom. As Steve said, a doubling of Chinese exports in this last 6-month period. However, the signs are a little bit mixed. So there was the end of a tax program in April. So we saw a huge surge of solar out of China. But then in the last two months, we've seen a bit of a dip since then. So we're still watching that very closely in terms of overall this year, will we see a surge in solar exports from China because of the war? So it's a little too soon to say.
I'll just pick up on there, but I don't know if we can bring back up the results of the poll, because that was quite surprising to me. There's a lot of optimism in the room this morning, and it was notable there. I think roughly 3/4 of respondents see the transition speeding up, which is really interesting. And I hope the discussions today we can maybe dig into some of the reasons why that's the case in this part of the world. Lily, you mentioned, I guess, the variance between some of the technologies. As you say, we've saw that big sort of crest of solar exports. Maybe that's coming off slightly in places. But does that mean we're seeing a sort of concurrent uptick in batteries as people are generating renewable energy? Are we seeing, more users want to store and to really harness the utility of that?
Yes, I'd say certainly. So far this year, we see steady uptick with the batteries. And even just looking at the data from last month's exports, we see 50% increase year over year. And so that's been a steady trend. And the Chinese companies we've spoken to, they have acknowledged that they see sales increasing because of the disruptions from the war. So we expect to see that through the end of the year.
Fantastic. I'm going to ask you a final question on this issue, but before I do, let's ask the audience. I said we were going to keep you busy. One thing we're interested in, I guess, is some of the implications of that surge in exports of Chinese clean technology. And so we do have another poll. And I guess the question is, whether we're seeing concerns and tensions. Is this wave an increase in Chinese clean tech exports a source of potential help to bolster energy security? Is it a national security risk? Is it neither of those things, or is it both? Very interested to hear your views. Lily, when you're reporting, talking to people, how much of a concern is that so for some nations, they could shift from reliance on fuel imports to reliance on Chinese technology?
Certainly. I think countries in this region, have some level of wariness over becoming too dependent on any given country for their supplies, as they've seen from this oil and natural gas shock from the Middle East. But I think they see the risks of clean tech dependence as different from oil and gas in that, it's a long-term build out of solar. And so there wouldn't be a sudden shock in the same way. And overall, if you look at the fears, I think, of national security risks from dependence on Chinese clean tech in Europe or the United States, I think it's much more acute. We've seen cancellations of factories, Chinese factories in the UK that would have been built to supply wind power there. And so there's a much more acute sense of risk around, having Chinese factories build in Europe or depending on those supply chains. I think here, what I see for the most part is an eagerness to embrace cheap solar and wind and to bring down power prices first and foremost.
No, fantastic. We'll come back when we do have some results of that polling. But Ishka, I kind of wanted to move on. We've talked to Steve and to Lily a little about sort of some of the short-term risks, sort of some of the steps that are being taken to manage things in the short term. You spent a lot of time recently talking to investors, to funds about medium and longer-term risks, issues around adaptation. How those longer horizon issues are impacting their strategy and investment decisions. What have they been telling you?
So for a story I did recently, I looked at sustainability reports of 12 of the biggest private equity firms in the world. And I would say that there's been a step change in how they're thinking about physical climate risks. Earlier, it used to be one of the boxes to tick when you're doing your due diligence for an investment, but now they're actually spending a lot of time. They're developing in-house tools. They're working with external climate risk analytics vendors. They're building out platforms for assessing and monitoring investments pre and post, of course, when they infuse the cash, to see what the exposure of the company and its assets around the world are to physical climate risks. And for example, EQT, when it was looking to acquire a waste management company back in 2024, it looked at how exposed the company's roofs, the waste management company's roofs were to extreme snowfall and typhoons. And they decided to set aside cash in the future, cash for improving the roofs and making them more resilient. And this is exactly what a lot of PE funds are starting to do. They're setting aside more capital expenditure, more operating expenditure, in the future, of course, for the future. Or even working with some of these companies that they want to invest in and asking them to get insurance against their assets to make them investable, because they see climate risks, many climate risks as acute. Usually floods and hurricanes come up a lot in those reports as the most immediate and acute triggers, but also extreme heat. So Brookfield, for example, is talking to companies about cooling needs, and they're building that into their models, like how much money is going to be spent on cooling. Partners Group called heat an extreme, or rather an acute risk as well. And the mentions of physical climate risks in these sustainability reports actually doubled in the 2025 reports from a year ago. And this is something that it's a business decision to spend time and money on identifying these risks, because they will affect exit outcomes for these private equity funds. So it's not a do-good strategy, or it's not altruism or anything like that. It's something that they can take to the C-suite and say, look, this is going to affect valuations on exit, so we have to do something about it.
Quite. No, that's we'll come back to that. I'm just conscious we had some results and some interesting results from our second poll. I don't know if we can bring them up again. I guess slightly reflecting there, Lily, what you were saying, that there certainly is some concern, and that's understandable. And I guess that's why we're seeing perhaps many of you in the room work on development of domestic supply chains as an alternative and a supplement to those Chinese clean tech exports. To shift back to adaptation, some of the themes that you've been looking at, Ishka, I guess we're also seeing, if not funds, investors take action, at least start to recognize and think through the implications of what we might think of as quite extreme risks. What JP Morgan have recently called sort of climate black swan events. Previously, these have been catastrophic potential risks that may have been seen as unlikely. We're seeing a shift in the investment space. Are people taking these things more seriously? Are they acting, or is it sort of think through the implications at this stage?
I would say that adaptation is still very much seen as state spend, but more and more private capital is starting to talk about it, is starting to assess it. I don't know how much money they're willing to put into the theme yet, because there aren't a lot of investable opportunities. That's the general narrative out there, though GIC says that this investment class of adaptation investments actually generates $1 trillion in revenue already, and that's going to quadruple to $4 trillion by 2050. So there's money to be made in places. Investors are looking at it both through a lens of risk and reward. I would say more so risk at this point, and slowly moving towards that reward side of things. For example, we talked about private equity funds, but even when we look at the global logistics industry, which is a $35 trillion dollar industry, they're looking at sensor technologies for tracking shipments real time. And this is important for perishables, for example, food and medicines. When you're transporting that, there's really low visibility on a real-time basis on location and temperature that these goods are being transferred at. So there are companies developing that, and they're seeing 50% revenue growth on an annual basis. And they're seeing new investors come in. Wildfire risk management and technologies are seeing increased investor interest now, given everything that's happening in the US and Europe. So there are pockets that are starting to see more investor activity. I would say water management systems are another one. And what's helping the adaptation theme finally gain some recognition with private capital is the idea that it intersects with a lot of the other things that are exciting to the rest of the market, which is AI, for example. So making your grids more resilient. So sensor technologies for that, for example, or undergrounding cables, things like that. Investors are starting to find that it's an easy, funds are starting to find that it's an easy sell to their clients to say that, look, there's money to be made here. It's part of the AI theme, but it's also part of the adaptation theme, so that's helping.
You talked there about new technologies. I'm conscious that both yourself and Stephen, you both recently toured quite an interesting project in the northeast of Singapore that was deploying some pretty old technology to reduce the energy intensity of cooling, like a really key challenge when we think about extreme heat. I think we can see a photo. I'm not sure if you're in there. I think actually, Stephen, you may have taken that photograph actually. Stephen, what are we seeing? Can you describe it? What did you see and what was the intention?
Yeah, this is a district cooling system that was designed by Engie, the French company. They're one of the biggest, if not the biggest, district cooling equipment provider in the world. They worked on the one in Paris. I think it's the oldest or one of the oldest. And these pipes essentially they make water really cold, and then they send it throughout the building, and that cold water is sent through the air conditioning essentially to make all of the buildings in the area as efficiently as possible reach lower temperatures. And by, instead of, just using one of the cassettes or units per room that maybe we'll see in a lot of Singapore condos, this is, or in our office buildings where there's just one unit that sends the cold air through. This is for several buildings. It's for a whole campus. It was the
Singapore Institute of Technology?
Yes.
In Punggol.
In Punggol. What else did I miss, Ishika?
And Ishika, what's the climate benefit of using that kind of actually quite old-fashioned technology, but deploying it?
Yeah, so that the technology was first deployed in Denver in 1890, if I'm not wrong, for a meat cooling system or room or warehouse or what have you. To Steve's point about efficiency, so this is district cooling systems are supposed to reduce energy use by 30 to 50% because they're centralizing it in one unit. I would say that while we were touring this, what did cross my mind was the amount of water being used. It's crazy. There are gallons and gallons, like thousands of liters of water. So I feel like whichever country is looking to deploy this or whichever locality, you do have to study how water stressed that area is. But on the energy side, it's supposed to be much more efficient than having multiple buildings using multiple systems.
Fantastic. Do use the app, and if you haven't downloaded, do download that using the QR code to ask us any questions. We're very welcome to take questions. And while we see if you do have questions for us, Lily, I wanted to come back to your recent visit to China. You were on the ground recently in Inner Mongolia, and I do think we also have an image of some of what you saw there. You really saw firsthand some of the, not necessarily tensions, but some of the variances that are playing out in China's energy transition. What did you learn?
So this was a really fascinating trip. I was just in Inner Mongolia last month, and I hadn't been there in over a decade. And I think if anybody is interested in the energy transition in China, you have to go visit Inner Mongolia. It's the place, it's really a microcosm for what's happening across the country. And what I was blown away by was just the scale of renewables that have been built in the last decade. So in this image, you can see this massive solar plant I visited, which is actually a small scale solar plant for Inner Mongolia. It's like not even in the top 10, I think. So in the last decade, Inner Mongolia has become the #1 producer of wind energy in China. I think it's number 2 or 3 for solar. It's just everywhere you go. But at the same time, coal remains very, very dominant in Inner Mongolia. It's the number 2 producer of coal in China, and energy security is very important there. So I think my big takeaway from the trip is just even with the incredible speed of China's renewable energy deployment, coal remains so dominant and central when you think about both central planners and also local governments in these coal regions. And what they're doing is they're basically changing the role of coal in the energy system rather than letting it fade away. And so in Inner Mongolia, that happens in 2 ways right now. One is in the power sector, we see renewables surging to cover new demand and even go beyond that to exceed new demand. But at the same time, Inner Mongolia is building more coal plants still than any other province in China. And for policymakers, that's about a concern that going forward with AI demand and other things, they may not be able to meet future demand with renewables, but it means a huge amount of coal plants are still coming online. And in the chemical sector, we see a huge surge, too, in use of coal for the production of chemicals instead of oil. Again, that goes back to energy security with the war. And so it really brings us back to this question about like the speed of China's energy transition going forward, whether or not policymakers can start to actually decrease the use of coal rather than just shifting it over to new uses.
Quite. And when we think about policy, and we've had a raft of not only the most recent 5-year plan, but we've recently had the sectoral 5-year plans. And that's sort of built on this impression that China's climate policy remains quite cautious, quite measured. And yet we look at the emissions data and that shows improvement. We're seeing emissions fall, slowly, but fall. Just help us sort of understand, why is there that tension between goals and ambitions and the actual evidence that we see?
So last year we did see emissions fall just a little bit in China, which may be the beginning of a turning point, but it is too soon to say because of what I just mentioned and saw in Inner Mongolia. With the rapid increase in energy demand from EVs, from factories, from AI, we see coal still being built. And so whether the power sector can continue to decarbonize in the coming years is a big question. And policymakers, as David, you just said, are very cautious. They want to make sure they can achieve their climate targets. And so they've set relatively conservative targets both for 2030 in the new 5-year plans and for 2035 in their Paris targets. And, for some climate watchers, that's frustrating. They think China can push faster with the scale of deployment. But with these energy security concerns in these energy and climate 5-year plans, China's very clear. Coal is the backstop of the energy system. That doesn't mean it won't change to become more flexible to support renewables, but it is the backstop. And so going forward, they're looking at how can they maintain security while also starting to make sure they're using more of that renewable energy that was built in the last 5 years. So that means, moving AI data centers towards the west where there are a lot of renewables, making sure huge power lines are built to connect demand centers with the supply of renewable energy. So we're getting to a kind of trickier phase of the energy transition in China where it's not just build, build, build. It's starting to change the system to actually make sure it balances correctly and all of that. So a trickier phase.
No, absolutely. And look, as we sort of come towards the close of our session, I'm going to put all of you on the spot. If we were holding this session in a year's time, and hopefully past some of the volatility that we've seen as a result of the conflict in Iran, what then is going to be the most important driver of the energy transition Will it still be energy security, or will decarbonisation and the climate agenda be back in the driving seat? Stephen, I'll give that to you first, if you can be brief.
Oh man, it's a good question. I think from where I stand, what I've seen has been the biggest driver has been just affordability. It's households and businesses. It's not so much energy security. It's trying to get the energy at the cheapest possible rate. You're seeing that in the Philippines, you're seeing that in Pakistan, and I think the driver of that is no longer going to be solar, which it was for a while. I think now it's going to be batteries. Yep. I think the big thing will be how can we make batteries cheaper on not just for BESS on a grid level, but also for households and businesses to get them installed and working well so that they can reduce their footprint and reduce how much they pay.
Mm-hmm. Ishika?
I think well, the results of the midterm elections in the US will have an impact on the decarbonization agenda there. But I would say in addition to affordability, accessibility, and there's so much discussion about grid investments, hopefully we'll see some of that play out in a year's time to see whether it's bringing down costs or whether it's working out as an investment thesis. But yeah, I think the US will set the agenda on how much climate policy will make an impact.
Lily, and
I would say both. I'm going to dodge the question and say both. I think from the China perspective, both of these themes are critical, and they can go hand in hand, but there will be tension, year by year, depending on what kinds of shocks we're seeing this year in particular. We're seeing that, as I said, surge in use of coal for chemicals because of the war. We may see, back steps like that going forward as well.
That's fantastic. Thank you all. Join me in thanking our panel, and really enjoyed the discussion. Thanks very much.
Please welcome to the stage Anne Pham, Deputy CEO of Investment at VinFast, for a conversation with Bloomberg's Andrea Tan.
Good morning. Now, Anne, VinFast stirred imaginations with the launch of its compact VF2 priced at around $7,000 in Vietnam. Now, in Singapore's context, that would be a dream come true. So let's talk about the news of the day, and that's a big one, geopolitics. We've got the threat of tariffs looming, with President Trump set to impose broader duties across dozens of economies by Friday. And then there's tensions in the Middle East and curbs on rare earths. Tell me, how do companies like VinFast sustain operations in a volatile environment like this?
Wow. Okay. First of all, I think thanks very much for having me here at the conference. We are indeed quite excited about the VF2 in Vietnam. Only after 3 days of launch, we've received nearly 29,000 orders. So we are very excited about this vehicle. In total, VinFast actually has a lineup of 16 different four-wheel vehicles and 15 two-wheel vehicles, as well as 3 bus models. So in total, the entire fleet is fully electric vehicles. And as you can see, we are very committed to the sustainability drive. As a company, when we look at the geopolitical volatility in the world today, including tariffs, we have done several things to ensure that we are invested for the future. I think in terms of manufacturing, first of all, I think in terms of manufacturing, not only do we have manufacturing in country, but we've also invested in manufacturing hubs and in future to be positioned as export hubs in India as well as Indonesia, because Southeast Asia is one of our main driver for growth. Besides manufacturing, we're looking at localization of sourcing. So the supply chain needs to be sourced, if not locally, then within the region. When we started VinFast EVs VinFast at all in 2017, there was no automotive industry that's local in Vietnam. So a lot of the equipment, the parts are brought in from overseas. Today, excluding the battery, 75% of VinFast parts are actually sourced within Vietnam. So we've basically built up a very vibrant, robust local supply chain network. And as we expand internationally, that's what we are trying to do as well. We work with our domestic partners to go with them overseas so that we become more flexible when we source for parts, and we try to supply to each of the market. With the broad EV lineup that I mentioned earlier, when we go into each market, then we do a lot of surveys, we do a lot of market entry studies, and we select within our portfolio what suits the local markets the most.
How does this localization help you cope in this tariff environment? Does it help?
Yes, I think with taxes rising, especially for imports and export, it does reduce the cost of ownership or the purchase price first for customers when they purchase vehicle that has a higher local content, right? So definitely producing locally not only improves on time to response, manufacturing time, like I mentioned, but also lowers the purchase price. On top of that, I think to lower owning EVs is lower in terms of total cost of ownership for the customers because of lower maintenance costs. And last but not least, I think we also try to provide better sales after sales to bring down again the total cost of ownership for the customers.
VinFast has got grand plans in the US, and a lot of these tariffs are coming primarily from the US. Could you tell us what are your plans for the US in this current environment? Are you going to try and ramp up production there? Because I do know as well that North Carolina in May sued VinFast over downsized as well as delayed plans.
VinFast, I think at the moment has sales, in various parts of the world, including North America and the US. We have manufacturing plants, and I think we are also producing in these manufacturing plants in the rest of Asia as well. For the US, I am unfortunately unable to comment. But I think our plans for sales in the US basically stays on course.
Okay. Fair enough. I guess given that it's a live lawsuit, there's a limitation on what you can and cannot say. Can you talk about rare earths? China has implemented curbs on rare earths, and that obviously has got an impact on EV makers because a lot of rare earths goes into the batteries used. Where does VinFast stand on this, especially given that Vietnam has the world's second largest reserves of rare earths? Does this pose less of an issue for you?
I think the broader Vin Group is a conglomerate and the largest one in Vietnam, as you probably are aware. I think at various parts of Vin Group, we are investing in metals. We're investing in sustainable energy, and resources is one of the things that I'm aware that Vietnam has a very big resource. But I think potentially we could look into that in the future. For VinFast, at the moment, we source our batteries from several suppliers, and within our company, we comply with the relevant, environmental as well as ESG standards.
Okay. Are you planning to step up production in Vietnam, for example?
I think in terms of raw materials, I'm not aware of. Yeah.
Okay. We touched very briefly on tensions in the Middle East, and that's caused, very volatile oil prices, and it's impacted all of us in some way or other, be it electricity prices or pump prices, as well as a supply chain. How is this impacting consumers who are thinking, should I take the plunge and buy an EV, and how are you pivoting?
I think tensions around the Strait of Hormuz clearly have been one of the stronger drivers in the recent months for EV adoption, not only in, the places where there is such tension, but throughout the world. In many of our target markets, oil is still a primary import in terms of energy uses. And this has kind of clearly driven consumers to look at EVs as a viable option for transportation. In Indonesia, BEV sales is increasing. Our market share, or rather our monthly sales in Philippines, have also seen monthly record highs. In Vietnam, I think it's a bit slightly different for VinFast, especially because we've become the #1 selling brand across EVs and ICE since September 2024. And today our market share is heading towards 40%. Our sales in Vietnam have been fairly strong, and the government have, kind of encouraged EV adoption in transportation. So I would say, broadly speaking, the transition towards EV benefited not only from regulatory push around the world, but certain volatilities as well.
All right. Sounds like a pretty rosy picture there. And your chairman at Vingroup has talked about the break-even point for VinFast. If I remember right, in April, he pushed it back to sometime next year rather than end of this year. Given the picture that you just painted, are you likely to hit break-even point sooner rather than later, perhaps?
Yes, I think we're on track to break even in Vietnam by 2027. And in international, and as a company as a whole, I think we're working very hard, as I mentioned earlier, on the portfolio lineup, as well as volume increases, which ultimately will improve the bottom line.
So break even in Vietnam by 2027. What about VinFast as a whole?
Will be shortly after Vietnam.
Okay. So we're still looking at 2027, perhaps?
I think in a couple of years is, I think, what we're working towards. Yeah.
Okay. You talked about how VinFast was founded in 2017, and it's got the tagline, "The future of electric mobility has arrived." In less than a decade, you've got footprint in Asia, in India, Indonesia, Philippines, Thailand, Europe, Middle East, and North America. Very ambitious and very bold. And of course, along the way, VinFast has faced some challenges as you race across the globe, even as consumers elsewhere have embraced VinFast. We've talked about the lawsuit, of course, which you can't mention, and it's understandable. Do you think these are teething pains, or was the expansion overly aggressive? And what's the key takeaway for investors and the markets out there?
Well, I suppose we, as an organization, don't take on easy tasks. But I think the achievements that we've made is, I think also sometimes is, something that we try to encourage ourselves as we move forward. For example, I think in the first half of 26 this year, EV sales for us grew over 70%, I think nearly 80% year on year. Mm-hmm. Two-wheel sales grew nearly 300%. Year on year. And I think it is not just this year that we've been growing. I think in the past years, since when we first started the switch from ICE vehicles into EV vehicles, our sales have increased, in terms of times, not percentages. Despite the fact, or because of the fact that EVs is also fast growing, in terms of total passenger vehicle, this sales growth for VinFast is still very impressive. We've localized innovation, R&D. I mentioned earlier there wasn't, an automotive industry within the country. Today, we basically have proprietary innovation and R&D, new platforms for our new vehicles. And this shortens the product development time as well as the cost to bring to market all of these products. Because of VinFast and within the ecosystem of Vingroup, we've also launched new technologies like charging, power generation that is sustainable and green. So I think some of these achievements that we've done in less than a decade is something that spurs ourselves and our investors on.
Right. And given the lessons and the takeaways over the past decade, how is VinFast trying to refine its international strategy, perhaps? Are you going to be focusing more on certain key markets and perhaps, maybe scaling back or rethinking others?
Well, I think broadly speaking, EV sales or EVs as a percentage of passenger vehicles is fast growing, and we as an organization definitely want to capitalize on this trend. I've mentioned also a broad product portfolio that starts from, like you mentioned, 7,000 MSRP per vehicle to one that's about $200,000 or even higher. And also a breadth of two-wheel vehicles. In the markets that we are growing very fast today, demographics, incomes, etc., are also similar to our home markets. Right. And last but not least, I think we have a very unique ecosystem strategy, whereby within VinFast or the adjacencies of the mobility ecosystem within Vingroup, we have charging, we have robotics and things like that. So we are also actively looking for these opportunities in markets where we expand.
Great. So could you tell me more about these opportunities? Are you looking at organic growth, or are you looking at mergers and acquisitions, partnerships?
Well, I think first of all, we look at the market and its potential, and whether we have, and if we do not yet have, then we try to innovate products that suit the market. Then, partnerships, M&A or organic growth are all of the tools that we use in order to head towards those markets.
Okay. I'm sure the bankers in the audience would be very keen to hear that, VinFast is looking at all of the above. I'm sure you'll be getting lots of pitches very soon. So tell us, across the globe, which region has the most potential, either for, organic growth or partnerships, or more importantly, I guess, M&As?
It started with sustainability and M&A.
Well, it's also about, sustaining the business.
Of course, yes. Well, I think Vietnam being our core home market, I think we are firstly working with our sister companies in a lot of interesting things, testing, autonomous driving, pilot testing autonomous driving in some of our ecosystem. And then so that's sort of the place where we innovate a lot. Beyond Vietnam, then Asia, where we've invested organically in at least two factories in Indonesia and India. Both factories are already producing and have room for more phased development and expansion. And of course, I think beyond Asia, we have sales through dealerships in North America, Middle East, as well as Europe, so on and so forth. And in all of these markets, there's also, of course, places that we look out to try to localize manufacturing. So yeah, I think those would be the priority regions that we look not only for manufacturing, but also partners that help us bring products to the end consumers.
Okay. Manufacturing, that's an interesting one. VinFast is selling 2 factories in Vietnam to try and cut some $7 billion in debt. Are you on the path towards building more factories on a net basis, given what you just mentioned?
Well, I think given the total volumes that we are heading towards and given our proven growth, indeed, we are looking at increasing manufacturing capacity. What we did in Vietnam, and the transaction has already been closed, is to sell our manufacturing arm in Vietnam in order to move towards a more asset-light, R&D focus, product development focus, sales distribution focus, OEM model that I think many brands, not only within the EV OEM world, but also in consumer electronics production are moving towards. So the liability that we managed to move off balance sheet was also a benefit for us in consummating that transaction.
Right. Let's pivot back to sustainability. How does the manufacturing, moving towards OEM and an asset-light model, how does that fit into the sustainability puzzle? Does this help in the sustainability of, say, for example, lowering your carbon footprint?
Well, I believe that to the extent that we invest in new factories, we comply with international standards. The first factory we built in Vietnam was actually related to the first ECA using German and Austrian technologies in Vietnam as well. As we invest in new factory with modern standards, that should help towards more sustainable manufacturing as a whole. When we transferred the factories in Vietnam, we ensured that our acquirer complies with all of those standards, and we as an off-taker also have all of those requirements in mind. So I think as we invest and as the organization move forward, we're committed to sustainability as a whole, and that not only is an environmental objective, but it's also about energy reliability, as well as new innovation, new R&D, which is what excites all of us, isn't it?
Thank you. Well, I'm sure we've got lots of exciting plans coming up from VinFast, and I would really love to continue this conversation, but the time is up for us. So, ladies and gentlemen, as much as we like to continue this conversation, can you please join me in a round of applause for Anne?
Thank you. Thank you, Andrea. Thank you, everyone.
Please welcome to the stage Shaheen Contractor, Senior ESG Analyst at Bloomberg Intelligence.
Hello, everybody. Thank you for joining. So today we're going to dig into the exciting world of ESG and sustainability funds. We're going to look at where money is going. In other words, what strategies are attracting capital. And secondly, we're going to dig into the performance of these funds. We're also going to hone in on climate strategies in particular and better understand what the current geopolitical environment means for the energy transition. Now, before I dig in, just a quick introduction. So I cover ESG for Bloomberg Intelligence, which is Bloomberg's research team. I sort of describe my job as taking Bloomberg's ESG data and providing analysis into it. So writing about trends, drivers, basically how our clients can use this data when they're making investment decisions. So let's dig straight in. When it comes to sustainable funds, where are assets and flows going? So on the screen, we see that assets in global ESG and sustainability funds crossed about 3.4 trillion in the first half of this year. Now, we also see that about 85% of these assets, so the yellow bar, is Europe. Now, I always knew Europe was dominant. I don't think I expected it to be this much. So North America is somewhere close to 10%, and APAC is about between 5 and 7%. So just a line on what goes into this chart. So we're really tracking assets into all publicly traded funds. So think ETFs and mutual funds. And what we're really looking for is ESG labeled funds. So ESG, climate sustainability, whatever you want to call it, in the name or benchmark of the fund. So this is not, the broad ESG integration. These are ones where ESG is specifically in the name of the fund. So ESG related, ESG sustainability, etc. Now, to paint a better picture of demand, let's look at where flows are going. So such funds in the first half of this year saw about 5 billion in outflows. Now, while there's still outflows, as you can see, this is much less than the 110 billion of outflows that we saw in 2025. Now, 2025 is a very different story, right? It's our first year of outflows after years and years of net inflows, most of which are above 100 billion. I'll give a reason for these 2025 outflows. So a lot of it, climate strategies in 2025. The political uncertainty caused investors to pull out, especially in North America. And the second piece is that about half of these outflows actually moved out of publicly managed funds, out of ETFs and mutual funds, and into separately managed accounts. So they are still ESG strategies. They just moved out of the public markets into separately managed accounts that we don't track. So in a way overstated, but still net of everything, we did see outflows in 25. Now, coming back to the first half of this year, even though we see outflows, there are a couple of bright spots that still emerge. The first one is ETFs. So ETFs took about 24 billion in inflows. So it's very clear that investors still prefer these low-cost, transparent strategies. And fixed income saw about 14 billion inflows. So obviously equity and non-ETFs saw outflows. When we look at themes, the first half of this year was really all about clean energy. Clean energy saw about 10 billion in flows just in the first half this year. Now, I say this is a near record because we've never seen the first half be this much except for 2020 when Biden came into power. So again, near record flows, all of this driven by performance. So in the chart to the right, we have the S&P Clean Energy Transition Index. And what we really see is outperformance. So clean energy was one of the best performing themes of 2025. And the first few months of 26, we've seen a bit of a downtrend after. And all of this driven by the AI-driven power demand. So AI, obviously, we've heard about this unsatiated need for energy. And that's really favoring anything that is fast to deploy. So think renewables like solar and batteries. A colleague of mine once said that right now anything that produces electrons and produces it fast is where it's at. And we can see that in this chart. Another theme is transition metal funds. So transition metal funds saw about 1.6 billion inflows. Now, that might not seem like it's too much, but it's 10 funds. We have 10 transition metal funds. So given that small number, 1.6 billion is quite a lot. And again, you can see the same trend. You can see the same trend of electrifications as, renewables outperform the metals that go into grid build out, energy storage, etc. Metals like copper and lithium, those are the ones that outperformed and saw flows. Now, I don't think we can talk about ESG funds without talking about rebrandings. So on this chart, we can see that about 20% of funds have rebranded away from ESG. So that's that red and pink bar that you see. About half of these dropped ESG from the name, and the other half changed labels. They went from things like ESG to alternate labels like screened or leaders or whatever that means. Now, all of this driven by ESMA regulations in Europe. So 90% of these rebrandings are all European funds. So ESMA regulations in Europe require funds domiciled there that have ESG in the name to meet stringent regulatory criteria. So funds went ahead and dropped the name as a result of that. Now, coming to a second topic, which is performance. How have these funds performed? We've tracked US allocated funds, and what we see in the chart to the left is over 1 year, 12% of funds have beaten benchmarks. Now, that's not good. That's a low number. But if we look in the chart to the right, we can see that outperformance really comes during periods of drawdown. So periods when the market goes into a downward spiral, the peak to trough value. Now, we can see that in 3 of the 4 largest drawdowns we've seen since 2015, over 60% of funds have outperformed and beaten benchmark. So that leads me to believe that such funds tend to outperform when the markets go down and they fail to keep up in a bull market. And when we ask ourselves the question why, we find that's because of ESG funds' factor exposure. So such funds tend to tilt towards factors like quality. So these are companies with high profitability, and they also tilt towards low volatility. And that's just how these factors behave. They tend to outperform during down markets and underperform during bull markets. And I think that what explains this space in a good way. Now, let's dig into clean energy in particular. So when we saw those 10 billion inflows, I asked myself the question, is this sustainable? And over the long term, we do think that, the current geopolitical tension, energy price spikes, they are positive for renewables because they make renewables relatively more cost effective. Over the short term, we do see mixed signals. So what we've done here is we took companies most held in clean energy funds, and we evaluated them across a couple of fundamental and technical metrics. So what we can see here is that while clean energy has lost price momentum, to some extent we saw it falling off the curve a little bit, it's now performing in line with the market. Earnings are still accelerating, which is the green bar when it comes to earnings trends. In other words, for these groups of companies, earnings over the next 12 months are expected to increase faster than the previous 12 months. So earnings acceleration can continue to support these companies. However, revision breadth is negative. Revision breadth is earnings expectations today versus 3 months ago. So in other words, analysts were more optimistic about clean energy 3 months ago than they are today. So that gives us this mixed signals where we have earnings accelerating, but the trend is decreasing because revisions are going down. So it's really a mixed trend that we see going forward. Next is another very interesting trend when it comes to clean energy. So the blue line, which is this S&P Clean Energy Index, you can see it typically moves inversely to real yields. So real yields, so clean energy being capital intensive is inversely related discount rates. So you have higher discount rates, you have lower returns. For the first time in 2025, we see clean energy outperform despite real yields not falling. And if you can see from 2014, we haven't seen that before. Every time clean energy outperformed, it was real yields coming down. And that suggests this structural demand driver that I talked about, this AI-driven power demand that was coming in and lifting all these stocks up despite real yields not falling. We do see rate sensitivity coming back. Again, we said that clean energy is coming down as of the end of this chart. And that's really this AI-driven power demand. In my mind, I think it's being tested a little bit. We have to see this AI-driven power demand convert into earnings for clean energy. I think that's happening, but because of bottlenecks and execution delays, that's not happening to the extent that investors perhaps hoped. Last topic that I'll touch upon is what I call this sustainable or ESG misfits. So these are companies that are very popular in ESG funds, but have red flags. So it's almost what I call overlooked risks. So here, for example, we have companies like Ravi, McCormick. These are companies that are popular in ESG funds, despite having governance red flags. So these companies have a dual CEO, which means that the chairman is also the CEO, which compromises on independence. And they have unequal voting rights, which means shareholder rights is concentrated amongst a select few. Again, these two together are governance red flags. But still, we see that these companies have an ESG fund inclusion rate, which is quite high. Now, this metric is measuring the number of ESG funds owning a company divided by all funds. So a number of 10 means 1 in 10 funds owning the company is ESG, 10%, 1 divided by 10. And that's quite a high number. And we really find this across the board. We find a number of companies in ESG and sustainability funds with a lot of governance red flags. So to me, that's a overlooked risk within sustainability fund holdings. My last slide is another risk within fund holdings, which is divestment risk. Now, I think as AI power demand, energy security, the political landscape keeps evolving, I think companies are going to keep rolling back on their climate reduction goals. An unintended consequence of that is divestment risk from a company's ESG investor base. In other words, it's the amount of a company's market cap owned by ESG or climate investors that could sell if they roll back on their goals. So the example here is to the bottom, we have Scotiabank, which was the most recent to roll back their financed emission goals. Now here we can see that only 0.74% of the company is owned by ESG investors. So that's not much. But what if a Swiss Prime or an ISS towards the top of the chart were to roll back? These are companies where over 5% of their market cap is owned by ESG or climate funds. Quite a big risk if they decide to roll back their climate goals. So that brings me to the end of my presentation. I think maybe 3 takeaways. So the first one is the first half of this year was all about clean energy, though I think there are some risks going forward. The second one is sustainable funds tend to outperform during market downturns, but they fail to keep up when the market heats up. And last but not the least, divestment risk. I think that's going to become increasingly important to monitor going forward. And I'll leave you with one thing I always tell clients, which is that whether you're an ESG investor or not, you should know when there's concentration within your investor base. So if a substantial amount is held by ESG funds, I think every investor should be tracking that and monitoring that. Thank you, everybody. Enjoy the rest of the session.
Please welcome to the stage Jennifer Richards, CEO of Asia Pacific at Aon, and Benedikt Signa, CEO at the Southeast Asia Disaster Risk Insurance Facility Insurance Company, for a conversation with Bloomberg's Ishika Mukherjee.
So we're going to talk about risk protection today. Uninsured losses, of course, crossed $100 billion last year, according to Swiss Re. Rather, insured losses and uninsured losses were maybe a multiple of that amount. And total spending on insurance premiums, extreme weather, and resilient infrastructure crossed $13 trillion over the past 12 years, according to Bloomberg Intelligence. The sense I get is that we're at a critical juncture for the insurance industry with AI and with the explosion of data from satellites, geospatial data, e-commerce, all of that, that can really help you build models that link natural disasters to outcomes, including macroeconomic outcomes. But I'm very excited to be talking to you today, Jennifer and Benedikt, about this and what this means, what AI means as well, data analytics for the insurance industry and reducing that protection gap in Asia today. Maybe I'll start with you, Jennifer, and talking about the protection gap. Climate-related losses are growing, but an increasing amount or number of properties and land in the region are becoming uninsurable or slowly, going forward in the next few years, it will become. Where do you see the biggest pockets of vulnerability and where insurance is going to potentially be withdrawn?
Yeah, thank you. And thank you so much for having us here today. Just in terms of the protection gap, I think I'll reiterate what you said. Asia has the largest protection gap in the world, where we see a protection gap of around 90% as compared to 70% in the United States, 50% in EMEA. So it's clear that we have a gap, I think, in understanding around what the true cost is of some of these climate-related events, which, as you say, are leading to perceptions around uninsurability. And I think really at the heart of all of this, going to your point about big data sets and data and analytics, what's absolutely critical to this is that better data and insights are available to both companies, government entities, so that people truly understand what the cost is of these events. That will allow people to understand the true return on adaptation measures as well as resilience. I think, Ishita, you spoke about earlier how you're starting to see private equity firms and others really building into their due diligence what the cost is of climate-related issues. And I think that's the starting point, right? Right now, we actually don't have a true understanding of what the cost is of these physical climate risks. And I think that's where it starts, right, is we really have to understand that better. The insurance industry has actually been solving for this for a long period of time, right, taking data to help solve uncertainty. And one of the things that we've been really focused on is to bring to bear some large data sets that we've always had available for our large insurance clients, to essentially democratize that data, to bring it to our corporate clients as well as to governments and other entities so that they can truly understand, claims trends, actual data, asset-specific data around what the cost is. And so I think that's really the first part. The question around uninsurability and sort of stranded assets, I suppose, is really it's a good one. But I think it's one that we need to challenge ourselves to solve, right? Because that's just a question about whether insurance capital is attracted to insure something at a commercial rate in which someone wants to actually transfer that risk. Really what the question is how that we build in better resilience to attract capital to these events. And we are starting to see more innovation there. You know, one of the things we'll talk about, I'm sure, today is around things like parametric insurance, right, where you're able to understand with a more simple trigger what attract capital through better data and analytics to help make things that otherwise may not have been insurable, and to bring back in stranded assets into a commercial frame.
Mm-hmm. Yeah, and we will come back to that in the conversation, but you kind of skirted my question there. But I wonder if you have any particular sectors or countries that you're most worried about at this point in terms of providing insurance to from climate-related losses.
Yeah, and just to be clear, we arrange capital to support our clients and to support transactions. We don't actually take risk, and so we have a really good view on where we're trying to see pricing increases or assets that become uninsurable. And certainly the trend is climate exposed areas are certainly seeing higher volatility in pricing, more need for better data, and there's certainly pockets in Southeast Asia, parts of India, where we see extreme, I spent the last 14 years in Australia. There are aspects in Australia where government has had to come into bear around things like cyclone pools to help solve some of these questions. And Benedikt, I think, exactly some of the great work that you're doing around this as well.
Mm-hmm. Yeah, coming to Southeast Asia in particular, and the countries here don't really have the fiscal headroom. So for spending a lot on disaster resilience. So where are you seeing the most vulnerable pockets again to you, and how are you seeing any change in flows from the private capital space for insuring these parts?
Thanks, Jessica. Maybe just to set the scene slightly, we're ever slightly less well-known than Aon at this point, catching up hopefully soon. So SEADRIF is a Singapore general insurance company set up and owned by ASEAN Plus 3 finance ministers, specifically to address that growing protection gap. And the way we are looking at this is we act as a market maker, right? We talk about the protection gap. The question is, why does it exist? And so if I look at this, it's not that the private capital doesn't exist or the expertise doesn't exist. The insurance market had history of 200, 300 years. That's been around for a long time.
And in fact, there's never been more insurance capital available than there is today. Exactly. It's just finding different
So
places.
if we look at this from the public sector, and that's where I would say, Ishka, your question, where is the real need and an unaddressed need, it's actually a lot of what's public liability, which then flows through to a fiscal problem. But I see a market failure. Its demand is increasing, political awareness is increasing, including in Singapore, very much so across the region. Private expertise capital is there, but the market is not closing. So the question is, how can we bridge that market failure to start addressing the protection gap? And I see three main barriers. It's a question of price, it's a question of products, it's a question of trust. I'm sure we'll unpack some of those more.
Are you seeing insurability improve in any part of the region?
I think to improve insurability, we need to address some of those barriers, right? How can we make products fit for purpose? How can we achieve a price that is justifiable on the public side and actuarially commercially sustainable on the private side? And how can we build origination channels, go to market that actually make it possible and feasible? I absolutely do think that these points are changing, and I'm sure we go deeper into those. Across the regional governments we are working with, we're working very closely with the Philippines, with Indonesia, with Laos, where we started, across the region. There's a real shift change where the governments, the ministries of finance step up and say, this is not a civil protection problem, this is a fiscal problem, fundamentally a fiscal problem where the government has to take a role and do something different about this, because it's not only about disaster response, it's about attracting investment, it's about protecting supply chains, it's about protecting economic growth, human capital for the long term. So I think it's absolutely going in the right direction. We have a long way to go by getting the mechanisms right, the nuts and bolts right.
I think I'd reiterate that just around where we're seeing clients be able to attract capital to support their needs. The one trend I would say there, it's around the sophistication of the data sets to really help the insurance capital understand what the risk is that they're being asked to assume, and to be a partner in modeling an outcome that is sustainable for the insurance capital, but also meets the need of the client. And frankly, an element of that that's required is scale, which is why some of these public to private partnerships are really relevant, as well as where we see the most success would be some of our really large clients who can take a view across multiple asset pools, multiple locations. And I think you spoke before about private equity, also able to take a portfolio view across some of these matters as well. But scale, I think, is also a real critical element of it.
What types of products are you seeing the most demand for from governments, from companies in the region? What are they willing to spend the most on, and would be the biggest growth driver for your businesses in the next 5 years?
Well, certainly from my perspective, the traditional product, sort of the hero product of property insurance is absolutely critical. I think it goes without saying that is the bedrock of the protection. And when people talk about things like parametrics, which for people in the audience who don't deal with insurance every day, it's essentially assurance that's designed around simplified trigger. And it's more of a binary response around it pays or it doesn't pay when a trigger is met. And it has a very fast recovery speed and a simplified claims process. So people talk a lot about parametric insurance, and my observation on that is that it is typically used in support of traditional insurance or traditional approaches to insurance around an area where there's either a real need because of the catastrophic impact of a particular trigger, or because there is more efficient pricing to be had through a simplified trigger. But I think certainly that's getting a lot of attention, but I think I want to stress that it normally is in support of more traditional insurance arrangements.
I think it's slightly different in the public sector, where there's a lot more, and for us, definitely our work is primarily starting with parametric insurance. But that's also because it's often easier to understand and easier to set up, right? When we talk about protection gap, what I always find interesting is that very often when we talk about protection gap, the conclusion is, well, people writ large just don't know that they need insurance. We need to educate them better. I'd say most industries, if nobody's buying your product, you look at improving your product, you look at changing your distribution channels. I think in the insurance industry, we have to be honest about, are we actually offering something that's easy, that's fit for purpose, that whether it's public sector or private sector can adopt and can roll out and that actually use for the risk management. So the way I look at this for SEADRIF, this is exactly our mandate, right? We have a balance sheet, limited balance sheet, but to be in between public and private. And when we design a new product with a member government, we co-create it to be fit for purpose. We take it to insurance markets. And insurance markets say on day one, that's perfect, great, oversubscribed, take a market. I feel we haven't pushed hard enough. We expect in the public sector to come out of their comfort zone to learn insurance language, learn insurance products. I feel insurance markets also need to come out of their comfort zone. We need to find the middle ground. And very often that's what advanced developed markets have done around the world. We talked about this earlier in Australia, in the UK with Flood Re, in New Zealand, Natural Hazard Commission, in the US, in Florida, in California, earthquake. Everywhere there's in-betweens, there's translators, there's public pools of capital that take on some risk, either because it's too risky, it's a price question, we can talk about this separately, to help de-risk the cost, but also to help distribution, to help build trust, to be an in-between that unlocks the private capital on the other side. That's exactly what we're building for Southeast Asia.
There has been an increase in parametric activity, as you said, right? Even for glacial melt in Central Asian countries, I think that was structured recently. But what was interesting to me to see was Singapore earlier this month come out with a public consultation on captive insurance, right? And making it more attractive to have companies set up captive insurance. Do you think that's an alternative that businesses would consider in terms of retaining risk?
I think it's absolutely, it's absolutely fantastic, right? So that the arrangement essentially allows smaller to mid-sized corporates to essentially access captive structures in a rent-a-captive approach, which Singapore has set up. And I think it's really critical and wonderful to see the support there. But what I would say is that it doesn't solve anything if you don't have the right data to understand what risk you're looking to treat and what the pricing is of that risk. And so I think that frequently it can be viewed as sort of a panacea. Oh, we're going to get access to another lick of, another huge lick of capital. We're going to access the ILS markets. And this is sort of the utopian response to an affordability crisis. And I don't think it's that. I think it's another avenue to access capital, but it will not solve issues around understanding what the true price is of physical climate risk. And what the trade-offs are around adaptation and resilience as well, because there's no pools of sort of dumb capital out there, so to speak.
Just quickly on this, there's actually 3 use cases that MAS has published around this, and the third one is sovereign risk pools. I think we are probably the only one in Singapore at the moment, so we have quite a strong interest in this. What it helps us, and we have been waiting for this actually to come to fruition, or still waiting to come to fruition, is it helps you to segregate assets and liabilities, right? What the PCC, the Protected Cell Company, does, it helps you segregate liabilities so you can set up the rent-a-captive, you can bring in outside capital liabilities. For us, it also helps us segregate different public liabilities. So some funders may want to protect agriculture specifically, and we're looking at setting up a regional agriculture reinsurance facility and a market infrastructure facility that could be segregated in its own cell. Likewise, we're working with development banks to embed insurance into new infrastructure investments. This could be segregated into protected cells that come either because the funding comes from a specific partner or the liability, the risk belongs to a specific asset class. So that makes it much easier to stand up these solutions instead of right now we'd have to set up an SPV or we'd have to create a new subsidiary company. And likewise in your case with ILS, with cat bonds, it streamlines a lot of this. It makes it more attractive and easier to experiment, to offer bespoke custom solutions.
Absolutely.
Okay, I wanted to come to data analytics because that's something very interesting to both of you and a lot of people in this room, I'm sure. Can you give us a look under the hood and tell us what is the new type of data that you're actually using now when you're pricing policies, and what are kind of the new models and now the new challenges that are coming up, because maybe there's just too much data out there and that could muddy your assumptions and estimates.
I think fundamentally, and this wouldn't be a discussion in 2026 without a reference to AI, what we're seeing is that we've always had various models, which, various types of CAP models and sophisticated approaches to understanding data. But what big data sets and AI enable us to do is to work through the data much more quickly with larger data sets to help our clients see around corners and to draw insights over what were probably in the past uncorrelated data sets. And so just by way of example, we can look at things like not just the property impact from a given climate event, but also what the health-related impacts could be on a population through workers' compensation impacts, health insurance. And so it allows us to put together larger data sets to draw insights for our clients, which enable them to make more profound decisions around data sets that in the past we weren't able to connect. And so I think there's a speed piece, there's a quality of insights. But it does come down to your question around the data, and something that we're incredibly focused on as a firm, right, is in terms of establishing those data lakes, and creating the right level of governance and understanding of where we want to pull the data. And I think also as we, in the past, we've served a lot of our large insurance clients with very large, complex sets of data. Now we're trying to democratize the data and get it into models that are more understandable for a wider a set of the population, so that the speed and the accuracy can be there, which can allow us to have a much more profound impact across larger parts of the economy. And so I think that piece is incredibly important and really exciting about what AI is enabling us to do.
Benedikt, what new types of data sets are you using now?
So we're very small. We are a user of the innovation that comes out of the behemoths like Aon. But two things to add. So one is we did develop our own insurance product with a very different data set, actually very simple, dumb data, not big data. We're triggering insurance product against the number of people affected by disasters as reported by the government. Reports creates all other questions that the insurance industry had around this, what I said earlier, pushing everyone out of their comfort zone. But what it means, it's the data the government already uses for their decision making. It's not something new, it's not a black box, it's the data they have. And so for us, what we see very often as challenge is we need that big data, that innovation, the CAT models for the pricing, for the product development. But we also need to translate this to decision around information that somebody's comfortable standing and saying, I understand this and I can put money on the line for this. If you're in the public sector and you say, I have to make a decision between investing in schools today or protection tomorrow, that's a very hard trade-off to make and to publicly justify. Or in a business, do you invest in CapEx or do you buy insurance or do you buy future protection? It's a very hard trade-off to make. And if you don't have the right decision or information, we're not going anywhere. So in SEADRIF, we actually developed one of our principles is KISS, keep it simple, SEADRIF. Focused on everything we do has to simplify complexity for our clients. If it adds complexity, it's not going anywhere. And we know there will not be any uptake.
I mean, in addition to simplification, some of the private equity funds I was talking to were saying that they're engaging insurers on the idea of avoided losses.
100%.
Whether this forward-looking data, whether the forecasting data sets can actually help with pricing, changes to pricing today for a business that's agreeing to take up insurance. To safeguard itself against a natural disaster, right? But it seems like it's still early stages. Can you walk us through how you're thinking about changing the incentives for someone to buy insurance?
Yeah, absolutely. I think that's the risk-reward trade-off, right? And where, as Benedikt said before, what our role is as an intermediary is to really push the insurer partners out of their comfort zones around making sure that the right reward is there for clients who do invest in resilience. And so there are certainly, and I think the key there is a multi-year plan that is presentable and quantifiable in order to create the tangible result for the insurance capitals in order to value it and give you the reward. But I think you're, the carrot and the stick, right? We feel enough stick, but we've got to get the carrot. We've got to get the carrot working.
Just last word on this. I think it's just, since we're both from the insurance industry in different constellations, it's very important, I think, for us to emphasize to everyone else that insurance will not solve the problem. Insurance is one piece to help build resilience, but fundamentally everyone has to invest in resilience, has to invest in risk reduction, and then insurance can help you manage that residual risk. But of course, importantly, it can help you drive resilience through all business decisions beforehand. It's a pricing tool. It puts a price on risk. It makes risk visible. It puts an ownership on risk. But it has to be used to drive resilience into everything else you're doing. So fully agree with that.
Just one last thought. I know we're we're up on time, but
we're going to get rolled off the stage soon.
In terms of pricing chronic climate stresses, right, like extreme heat or environmental stresses like pollution, I spoke to a few insurers. There's still not enough frameworks in place for them to be able to quantify that and change the pricing or think of policies with regard to chronic risks, right? How far away are we from being able to quantify that and actually for it to start impacting premiums in countries such as India?
I think it's impacting premiums right now because we're seeing the losses come through in terms of some of these major events, right? We had a study in Australia that showed the impact on well-being and mental health claims due to the extreme fire events. And so I think it would be very naive to assume that those costs aren't currently coming through the system. We're seeing medical inflation in Asia plus 11%. Singapore, where we sit right now, is 16%. Right? So the spike that we're seeing in medical inflation costs are certainly coming through in some of these extreme weather events, loss of productivity, workers' comp claims. In terms of being able to quantify it on a standalone basis, I think certainly there's more of a challenge there. The other thing I would cite, though, is that only 60% of organizations are actually building well-being and workforce support programs in around weather-related events. So there's an opportunity there for all employers, frankly, to be turning their minds to how they support reduction efforts vis-a-vis weather-related events.
Very short last word on this.
Yeah.
I think as Jennifer said, rightly said, we are paying anyway for risk, for climate risk that materialize. We're already paying. So better risk protection and insurance does not mean spending more, it just means spending smarter. Thinking upfront about this, where the money comes from, how it flows, how you can reduce risk, and over time build that resilience.
Yeah, so assess your risks and take the necessary precautions after that. I think that's a good note to end on. We've run out of time. Please join me in thanking Jennifer and Benedikt. Thank you so much.
This year, more than 1 in 4 cars sold worldwide will be electric. By 2030, that number will climb up to 40%. ASEAN has everything that the global EV industry needs. Bangkok Bank isn't just a lender. We are a connector. We are building a seamless EV supply chain, from raw materials to final assembly. สามัคคีคือพลัง Together, we are strong.
Please welcome to the stage Chartsiri Sophonpanich, President of Bangkok Bank, for a conversation with Bloomberg's Lucy Liu.
A very warm welcome, Kun Chartsiri Sophonpanich, President of Bangkok Bank. With a front row view of the investment flowing into advanced manufacturing, digital infrastructure, clean energy, and regional supply chains, you have a unique understanding of how these shifts are reshaping both Thailand and ASEAN. Kun Chartsiri, to kick us off, how would you define the new industrial wave? And what makes this different from what we've seen in the past?
Good morning, and thank you very much. Yes, Thailand has gone through many changes over the years, from agriculture into manufacturing, and now it's also another significant wave that we are seeing that would also help to reinvent Thailand into the advanced manufacturing. We have seen significant investment into the data center, into the mobility, next generation mobility, into the electronic advanced manufacturing. These are quite important aspects that will help drive our economy moving forward. The foreign direct investment that we have seen over the last few years have been very significant and is important for this transformation. There are 5 to 7 sectors that have been the focus at the moment in the value-added agriculture and food, in the mobility, especially in the vehicle business, as well as in the advanced electronic manufacturing, in the pharmaceutical and food, in the healthcare business, as well as in the tourism and the creative economy. So these are quite different areas that have been moving. And the government also have been building more infrastructure for the energy supply, in the digital infrastructure for the data, as well as the AI, as well as in the human capital development.
And Khun Chartsiri, how are you seeing the relationship between energy security, the energy transition, and industrial growth evolving?
Energy has now become a very important part of the economy and provide the competitiveness. Yes, we have seen significant demand for the data center, for the stable energy supply, and also increasingly for the renewable energy resources. At the same time, the adequate water resources also an important aspect. So these have been quite important areas where the government has been focusing, including the direct purchase agreement, the upgrade of the grid system, as well as a new tariff structure in order to provide sustainable energy supply.
And as this new industrial wave gathers pace, where is Bangkok Bank focusing its attention and playing a leading role?
Yes, we have been operating across different industries and also across borders. We've been working closely with customers in different areas. We've seen significant increase in the data center, and through our experience over the years in the power project, so we're also moving with new customers in the data center, provide them with their project finance, including introducing different partners for the power supply, for the industrial estate, as well as for the related utilities, especially water supply. We're also working with different customers in the advanced manufacturing, especially in the electronic sector. We've seen significant investment in the printed circuit board, both from China and from Taiwan into Thailand. So we work with them for the credit facilities, working capital requirements, and the trade finance facilities. In other areas, like in the vehicle business, Thailand has been the hub for the auto assembly, and is now making a transition from the ICE to the EV. And different brands have been providing the manufacturing facilities in Thailand. So we also have been working with many of these customers in Thailand. And many of them also operated in the region where we have our operations. For example, through Permata Bank in Indonesia, we provide financing and support for the nickel and cobalt processing capabilities and for the battery manufacturing. So we work with these different customers across the region as well.
Khun Chartsiri, you touched on project financing, and it takes a lot to turn something from ambition to execution. What would be your take on that?
The important part is to understand the business requirements of the customer. And yes, because it's a significant investment, how to put different components together, and also many related parts have to move in synchronization. So we work closely with the main sponsor as well as all the relevant parties in order to make the project a success. And the successful implementation can also lead to significant efficiency and effectiveness. And so those are the capabilities that we work closely with our customers.
The key ingredients. And this October, Thailand will be hosting the IMF World Bank annual meetings. Khun Chartsiri, what would you like more global investors and policymakers to know?
It's a very important time for Thailand, and then there's also the second time that Thailand will be hosting the World Bank IMF. The first time was in 1991, and there probably should be, say, some 15,000 delegates from some 191 countries visiting the country. So it's important for us to demonstrate the capability of the country in different areas, including the financial system, the manufacturing capabilities, as well as the hospitality business. So it's very important, and we would welcome all of you to visit Thailand during that period.
You heard Khun Chartsiri loud and clear. Let's look ahead, Khun Chartsiri. How do you see ASEAN's economies becoming more connected with this new industrial wave?
The formation of ASEAN since 1960s have change and move forward in a very significant manner. Different country members offer different unique capabilities, and at the moment are very complementary to each other. And so one gain is no longer one loss. Actually, can combine together, and 1 + 1 will be 3 or 5, for example. And many times now, the operators also do not look into only one country, but would look into more an integrated ecosystem to provide the balance of the manufacturing and service capabilities. So this is quite a very important opportunity for ASEAN members to work closely together.
And finally, Chartsiri, what would be your best advice for anyone looking to build a sustainable business?
Sustainability will be with us for all the years to come, and resiliency is important. And linked to that will be the effectiveness and the efficiency of the operations. So using and apply proper capabilities, technology, and investment that will be planned over the years, including operation efficiency and effectiveness, the innovation, and product introduction, so that the service and the product capability that provide to the customer will be relevant. I think these are quite important aspects.
And what makes you the most optimistic or hopeful about the energy transition?
I think opportunities are now coming to ASEAN in a very significant manner, and different capabilities of different countries are quite complementary to each other. And in ASEAN, we have different sources of energy supply, and the ASEAN grid will be quite an important aspect to provide all these linkages and to use all these capabilities and the natural resources that each country have for the energy capabilities.
That's great to hear. Thank you so much, ladies and gentlemen, and to Chartsiri as well for joining me in conversation. Thank you.
Please welcome to the stage Ravi Menon, Singapore's Ambassador for Climate Action and Senior Advisor at the National Climate Change Secretariat, for a conversation with Bloomberg's David Stringer.
Well, thank you very much, and Ambassador, thank you for your time yet again. We're very lucky to have you appear at these Bloomberg events. I want to take you back to a recent lecture you made here in Singapore. You described climate change as the deepest form of entanglement. Explain to us, what do you mean? What are the relationships? How enmeshed are some of these issues that many people in the room and others are tackling?
Yes, thanks, David. I think in many ways the global economy, global financial markets are deeply entangled. It's a term I borrowed from quantum mechanics. And we've seen the effects of entanglement most dramatically with the COVID-19 pandemic, how supply chains were so connected, and we didn't expect disruptions on the scale that happened because of a pandemic. We've seen it more recently in the energy infrastructure, the Russia-Ukraine war and 2022, disruptions in energy and food supplies, and exactly the same thing happening now in the Straits of Hormuz being closed. We didn't expect so many multiple effects coming out of that single closure, and how interdependent various supply chains are. I think the mother of all supply chain disruptions will be the climate, because that is the deepest form of entanglement that the global economy has, that our supply chains are so intertwined. You take an El Nino effect, it has got multiple repercussions. If it hits the Mekong river system, you have food supply disruptions because of agricultural yields coming down, excessive floods. It'll affect hydroelectric power generation. That has knock-on effects on energy. So again, the same story is being repeated: energy disruption, food supply disruptions. And I think in the case of climate, the impact on livelihoods, on labor productivity, and a whole range of economic activities will all have knock-on effects down supply chains. In that way, I think climate is the ultimate entanglement because we share one planetary system.
Your work puts you right at the sort of intersection of public and private action, businesses, policymakers, investors. Do you see enough recognition of that problem? You know, do people that you talk to, or do they accept that perhaps the most important challenge is that climate challenge? And are you seeing enough of a response at this moment?
Yes and no. I wouldn't even argue that this is the biggest challenge. It really depends on the business you're running or the country that you're in. Priorities are manifold and with lots of things going on. Everything has to compete for attention. But this is going to be with us for a long while. I think that is what I would say of the climate crisis. We've got a lot of other things to worry about today, but 5 years from now, 10 years from now, 15 years from now, I think this will be our central preoccupation. We'll all be talking about the weather in ways that are not so pleasant. And I think the sense of perspective is sometimes lost with the daily bombardment of news. I don't blame Bloomberg for it, of course. You keep us informed. But I think there is so much distraction. And if all our worldviews are formed by having to check on Truth Social every morning, that doesn't quite give us a picture of what is in the future. The big pieces of news is the fact that 2024 global temperatures exceeded 1.5 degrees Celsius above pre-industrial levels. Last year was 1.4. It takes a few. The scientists would need a longer time period to assess whether it has crossed the Paris thresholds, but we are getting there. Every piece of news that's coming out on the climate front is worse than the climate scientists had predicted 5, 10, or 15 years ago. Sea levels are rising faster than expected. Scientists were figuring out why. They measured the melting of the ice caps that is happening. They measured all kinds of things. It turns out the oceans, by the way, absorb more than 90% of the heat that's generated. And the oceans are expanding. Volumes are expanding because it's hotter. And the carbon sinks in the world are declining. If you ask me what is the single most important piece of news last year, that is it, carbon sinks. Wildfires decimating carbon sinks and forests, oceans less able to absorb heat. The global energy system is now in imbalance, not reflecting back as much of the heat as it is absorbing. So very many breaking points are being breached. I think the number of people who pay attention to this are still in the minority. But what is very encouraging is that the determination of these people to do something about it is undimmed. And I see this in Ecosparity here. I see this in London Climate Week. And I see this in many conferences like these. Businesses who are thinking about their business 10, 15 years from now, or country or policymakers who are thinking about the resilience of their economies 10, 15 years from now, are thinking hard about this. And so what we are seeing a lot more now are public-private partnerships, coalitions of the willing, those who know this, those who understand these risks, and those who want to do something about it, but can't wait for the rest of the world to come together in a multilateral setting, are finding their own ways. And that is most encouraging. Plurilateral coalitions, public-private partnerships, getting things done, and many small things being done together adds up to something. And I think that is the most encouraging, and I see a lot more of that happening as the climate crisis gets worse.
Do you have confidence, optimism that those voices, people who recognize some of the medium and longer term imperatives, eventually will not win the argument, that's the wrong way of approaching it, but we hear a lot, and we've heard a lot even this morning, on the imperative of energy security, and that being the dominant driver of energy transition. Do you have optimism that ultimately what we'll see is people recognize it's a longer-term climate impacts, and we do have to return to thinking about how we mitigate those, how we adapt to them?
Yes. So I think the current energy crisis or energy crunch that the world is facing, for all its downside effects, from a climate perspective, is a net positive. Because I think increasingly now, the energy security agenda and the climate agenda are converging. And you see this in Asia. The sun that shines on your land, the rivers that flow in your country, the wind that blows on your seashore, those are yours. No, it can't be disrupted by war elsewhere. It can't be disrupted by closures of choke points and bottlenecks. And I think that understanding that real energy security comes from homegrown renewable energy is dawning much stronger now. This is a conversation I hear in many parts of Southeast Asia and countries like India, which have realized their huge reliance on imported fossil fuel. China realized this about 10 years ago. And while the focus is on China still building coal-fired power plants, what people miss is that it has built more renewable capacity than the rest of the world put together times 2. It is basically moving away from imported liquid fossil fuels, either LNG or oil, into renewables, solar and wind, and as energy security backup, coal.
Yeah, quite.
And what's interesting is that they're relying less and less on coal. The capacity is there. The consumption of the generation of electricity from that coal fleet has been declining steadily. Almost all the new demand is being met by new renewable capacity. India is trying to do the same thing on a massive scale. So I think this is a real positive. Of course, there are huge problems. Our grids, even in the advanced economies, are not built for renewables.
Quite.
So there'll be major infrastructure investments that are necessary. And let's face it, renewables always have intermittency problems. And to have the baseload electricity supplied on the same scale, you will need battery storage and massive amounts of investment there. But these are investment opportunities, because this is where the future is. And I don't even have to talk about electric vehicles. I think the queues outside petrol stations across Asia have driven home the point. This is just not tenable to have to pay so much more for private transportation. And so I think the take-up in EVs is also it's already happened on a double-digit scale in countries like Vietnam and so on, and it's likely to escalate.
No, quite. And of course, we were just hearing from VinFast earlier this morning on the outlook for EVs in Vietnam. Let me bring you closer to home and back to Singapore. To be a real catalyst for regional action, what is Singapore doing? What does Singapore need to do more of to encourage, to influence the actions of other nations in this region and even beyond?
Yeah, so quite apart from the active role that Singapore plays in the UNFCCC process, the COP process that is really the multilateral setting, and there's been good progress there on several fronts. I think it's now less an issue of having these commitments. There are commitments in place. I think it's more an issue of translating these into actions. And that, I think, takes place, coming back to what I said earlier, it takes place at the intersection of the public and private sectors, getting things done in businesses, in supply chains, and so on. And so that's where we've been focused quite a lot on. Given our strengths in finance and business and the centrality of Singapore's location, we've been pushing hard on 2 fronts, which we think will help to unlock a lot more private capital for climate finance in Asia. One's blended finance, and second is carbon markets. In fact, I don't see a solution to generate the kind of financing we need if you don't get these 2 things right. There is no shortage of private capital in the world. The total financial assets out there far, far exceeds what you need for climate transition. But of course, private capital is not going to flow there unless the risk and returns are commensurate. The returns are too low relative to the risks you're taking. Public capital is just not sufficient. Many governments are in deficits. The public purse is increasingly being squeezed. And so even if you roll in the MDBs, the multilateral development banks, it's not enough. What you need is to blend these two synergistically, where public capital plus philanthropic capital can help to de-risk projects, absorb first loss, make projects more bankable, and drive in multiples of private capital. And the theory is now being tested, and proof of concepts are being delivered. We're doing this on a platform level in Singapore, the Financing Asia's Transition Partnership. So the Singapore government has decided it's going to make its money work harder, commits $500 million as pure grant.
Yeah.
Now, if you were to use that to finance a few projects, yes, you will reduce CO2 emissions by so much. But what we thought was a better use of that money was to say, we'll use that to multiply 10 times. Every dollar we put in, we want to match it with another dollar from another sovereign or philanthropy, similar terms, first loss, grant capital, junior tranche. And then if you have a good junior tranche of about $1 billion, then to crowd in $4 billion of commercial capital, mostly debt. Banks will come in at that.
Yeah.
When you have first loss covering the first dollar on $5 of exposure. So that is being worked out, and we've already raised more than $1 billion on that basis. So it's not just what FAST-P is doing, it's what many other blended finance structures like this are doing across Asia. And we share experiences, share notes, and see how we can mobilize more. I think this is something that's going to move the needle. The other is carbon markets, a wonderful market mechanism to help decarbonization in places where they would otherwise not take place. At the same time, allow corporates who need to account for their residual emissions that they have not been able to extinguish. So when corporates in the advanced economies, or governments for that matter, have climate targets to meet, but the last mile is too expensive, a very good option is to buy carbon credits to fill that. When you've exhausted your abatement potential, to do that, because when you do that, you're reducing emissions in another part of the world. You're making another project viable. And you are also bringing investments into these areas in the global south, improving lives and livelihoods and communities. So it's win-win for all. I mean, we started by talking about entanglement. The whole logic of carbon markets is,
right.
A ton of emissions emitted in London is the same as a ton of emissions emitted in Jakarta. So if a corporate in London were to buy carbon credits to reduce emissions in Indonesia, you have achieved the same contribution to the climate. And that's what matters.
In developing, expanding, and credible carbon markets, how can Singapore further help facilitate that? Not only for emissions trading by corporates, but obviously we're seeing very quickly the development of, and Singapore has signed many MOUs and other kinds of agreements for international trading, as you mentioned, governments purchasing credits from other governments. To deliver real change and for people to have confidence, we need to have trust in that system. What's Singapore's role in ensuring that there's confidence in the ability of those markets to deliver genuine emissions reduction?
Yes, so this is fundamentally a question of integrity, and we've been working very hard to get the integrity levels up in the carbon markets. Several governments are working very hard together on this, and many NGOs and standard-setting bodies and other expert bodies are also working in this space. I think largely on the crediting methodologies to measure that a certain amount of emissions has actually taken place. What are the conditions that need to be put in place? Those methodologies in the last 2 years have come a long way, thanks to the efforts of Gold Standard and Vera, who have updated a lot of their methodologies, learning from past mistakes. And then you have meta standard setters like the ICVCM, the Integrity Council for Voluntary Carbon Markets, who've done a brilliant job of getting more guidance and more clarity about integrity. then I think we need to solve problems on the micro level, MRV, measurement, reporting and verification. The methodologies are there. What are the instruments you're using to measure that the methodology standards have been met? And so there's a lot of science that's coming in, and many solution providers emerging. They see this as a future growth opportunity. Singapore has been investing a lot in the R&D for MRV, whether it's geospatial or putting stuff in the soil to measure how much carbon is being sequestered and for how long. I think these are developments that are early stage, but I think have a long way to go. We are also doing a lot on the demand side. As you said, we've signed about 11 agreements now with other countries. So we're sending a very strong demand signal. An RFP for more than 2 million tons of nature-based credits has gone out. 4 projects across 3 countries in Africa and Latin America in place. And we are working more upstream now with project developers so that the credits generated are high quality and will be delivered on time. I think sending these demand signals is so important. When you try to create a market, you want to make sure the supply capacity grows. There's integrity and there is capacity to deliver. Some financing needs to be also in place there. And on the demand side, when you send powerful signals, advance agreement, purchase agreements and so on, then you have a symbiotic, synergistic demand and supply. And then there's the infrastructure, the exchanges, the registries, the clarity you need around those things and so on. So we're approaching this at multiple points, working with different sets of partners. And I'm quite hopeful that over the next few years, the carbon markets will be a source of growth for both, not just for climate mitigation, but also as a new source of value added and business opportunity.
And very briefly, when will we see those agreements, some of those agreements translated into binding deals? You know, when will the first transaction from?
Yes, good question.
Is it a 2027 issue? Is it a 2028? Is it?
We are hoping to have some credits by 2030 to meet our targets. But some of these, and that's what, and this points to one of the real challenges in these carbon projects. It's not like your regular financial market where there's a ready source of supply and standardized instruments that you can invest in and so on. These projects take time to get off the ground. And they need to be done properly so that they meet our requirements. And so we find that we have to actually work much closer with these project developers, which is what we've begun to do now. I can't give a timeline as to when the first credits will cross. We are also waiting with bated breath because we need them to meet our targets. But I think the recognition that these things take time and you need a lot of capacity building to make it work is now, I think, better appreciated. The likes of the World Bank, the Asian Development Bank are getting into this, offering policy advice, but also project development advice. And of course, what I mentioned earlier about MRV and all that.
Correct.
So we're looking forward to it. I think once first few transactions start taking place, that will be a very powerful signal.
And just briefly, because our time's running short, I did want to address adaptation. So just a brief question and response. Adaptation has very much been seen as the business and the job of government. Do you see more potential, more interest in private capital, private companies addressing adaptation issues?
Yeah, so that's another area we've been, Singapore is very actively involved. And now with the ASEAN chairmanship next year, we know this is going to be an important theme. And we are developing programs along these lines. Now, unlike mitigation, where every effort can be measured against a ton of greenhouse gas gas reduced or removed from the atmosphere, in the adaptation space, the outcomes are very varied. The benefits of a seawall that reduces flood risk, or how do you compare that with the benefits of cooling solutions that protect labor productivity during heat waves, vis-a-vis embankments on a river that protect the rice crops from overflooding. The outcomes are very different, and so you don't have a common numerator, and that is a challenge. And so we have to look at adaptation from the perspective of the downstream effects. And I think a good way to do that is what is happening to water supply, what's happening to food supply, what's happening to air quality. Because these are things people are willing to pay for. A pure adaptation project, as you say, may be seen as a public good that should be financed publicly. And there are many of such projects. seawalls, for instance. It's very hard to monetize or get a revenue stream out of that. The benefits for the people living on the coast are huge, but the monetization prospects, and I mean, there are creative people thinking about it, but it's not that straightforward. But if you are making a rice crop more resilient against drought, against flood, against encroaching salinity, that's increased agricultural yields, that is increased revenue for the farmers. That means a revenue stream is generated that makes it monetizable and bankable. You still need a lot of public capital because revenue streams are not that great, but you have some. And we have been garnering interest from private financial institutions to work alongside us. Not quite like FAST-P, but similar in concept. Blended finance structures. So we're testing that, kicking the tires with banks, with other financiers, how much they're willing to put in. If this amount of risk is covered, is the rate of return and the revenue stream sufficient for you to come in? And I think there is interest. That's been quite heartwarming, and look forward to see more progress on that front next year.
Well, that's great, and that's a positive note on which to leave it. Thank you so much for your time, and do join me in thanking Ambassador Ravi Menon. Thank you.
Thank you, David and Ravi. That was a great conversation. I encourage you to stay for 1 minute and not leave the room, just so I can give you some instructions of activities that you can do during the lunch break. So I'd say stay here if you can. But we have a few things happening during the break. First, one option is you just can have lunch and network right outside of this room. If you are pre-registered to attend the new Geopolitics of Growth briefing, please head to Clover 4 and 5, which is just out here to the right when you leave the ballroom. And for those of you who signed up to participate in our deep dives for conversations with our Bloomberg experts, you can grab some food out front and then from the buffet here, and then you'll head over to Clover 7, which is over here on the left. Those discussions begin right now. And then our main stage programming will resume in here at 2 o'clock. So we'll see you then. Thank you so much for joining us.